Section 1. Your investment basket. Understanding the basics of mutual funds. Imagine a basket filled with a variety of fruits. This basket represents a mutual fund, and each fruit is a different investment, like a stock or bond. When you invest in a mutual fund, you're buying a piece of this basket, giving you access to a diversified portfolio of assets managed by financial professionals. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Think of it like hiring an experienced chef to select the freshest ingredients and create a delicious meal for you. Mutual funds offer a convenient and affordable way for investors, especially beginners, to participate in the financial markets. They provide instant diversification and professional management, taking the guesswork out of investing. Instead of spending hours researching individual stocks or bonds, you can rely on the expertise of fund managers to make informed investment decisions. Section 2. Don't put all your eggs in one basket. The power of diversification. You've probably heard the saying, "Don't put all your eggs in one basket." This age-old wisdom holds true in the world of investing. Diversification is the key to mitigating risk and maximizing returns over the long term. When you diversify your investments, you spread your money across different asset classes, sectors, and geographies. This strategy helps reduce the impact of any single investment on your overall portfolio. If one investment performs poorly, others may perform well, cushioning the blow. Think of it like this. If you invest all your money in a single company's stock and that company faces unexpected challenges, your entire investment could be at risk. However, if you spread your investment across multiple companies and sectors, the impact of one company's struggles will be less significant. Section 3. The Baker's Dilemma. A story of risk and reward. Let's say there's a baker known for her delicious cakes. She decides to invest all her savings in a single ingredient, sugar. She believes that the price of sugar will rise and her investment will flourish. However, an unexpected drought hits, causing the price of sugar to skyrocket. While this seems like good news for the baker, it also means her production costs increase dramatically. Unable to afford the high sugar prices, she's forced to scale back her baking, resulting in a loss of income. This story highlights the importance of diversification. Had the baker diversified her investments across various ingredients, her risk would have been minimized. Even if the price of sugar increased, other investments could have balanced out the impact, ensuring a steadier income stream. Section 4. Navigating the mutual fund aisle. Exploring different types. Just like fruits in a basket, mutual funds cater to different goals and risks. Equity funds invest in stocks, offering growth but higher risk. Debt funds focus on bonds, providing regular income and lower risk. Hybrid funds combine equity and debt for balance. Index funds track market indices, offering broad exposure at low cost. Choose funds that align with your goals and risk tolerance. Section 5. Mutual funds. Your ticket to the investment world. Investing in mutual funds is like hopping on a train that's already in motion. You don't need to be a financial expert or have a large sum of money to get started. Mutual funds make investing accessible to everyone, regardless of their income level or investment knowledge. With relatively small amounts, you can start building a diversified portfolio and participate in the potential growth of the financial markets. Think of it like buying a cup of coffee every day. By cutting back on small, unnecessary expenses and investing that money regularly, you can gradually build a substantial investment portfolio over time. Remember, even small steps can lead to significant financial progress. Section 6. The Power of Consistency. Introducing systematic investment plans. Consistency is key when it comes to investing. Systematic investment plans, or SIPs, offer a disciplined approach to investing by allowing you to invest a fixed amount at regular intervals, typically monthly. Think of SIPs as an automatic savings plan for your investments. By investing consistently, you benefit from rupee cost averaging, which means you buy more units when prices are low and fewer units when prices are high, averaging out your investment cost over time. SIPs take the emotion out of investing and help you stay invested even during market fluctuations. Remember, time in the market is more critical than timing the market. Section 7. Start building your financial future today. Investing is not just about growing your wealth, it's about securing your financial future and achieving your financial goals. Whether it's buying your dream home, funding your child's education, or retiring comfortably, investing can help you get there. Don't let fear or procrastination hold you back. Start small, diversify your investments, and invest consistently. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Take charge of your financial well-being, seek guidance from a qualified financial advisor, and embark on your investment journey today. The power to create a brighter financial future is in your hands.